Hey, good morning, everybody, and welcome to this Tuesday, November 4th. Wow, November 4th, 2025 edition of Trading Places Live. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats. It's a pleasure to be with you this morning. As always, we do have futures off to a little bit of a rough start. They were down pretty sharply overnight. Give you the numbers here in just a second. So I'll go ahead and give you the futures now. But right now we've got the diamonds, which track the Dow Jones, down about a little bit more than 0.5%, close to 0.6%. Then we've got the S&P 500, which is down a little bit more than 1%, 1.09%. The QQQ tracking the NASDAQ down 1.5%. We haven't seen a big gap down like this on the NASDAQ very often. And certainly not recently. Yeah, some rough go here to start the day. Small cap Russell 2000 down about 1.4%, so doing just a little bit better than the NASDAQ, but certainly not very good start to the day. So we'll see where the market goes from there. It's been kind of interesting as we look over the last couple of months because most of you know I follow history pretty closely, and of course, history doesn't provide us any guarantees. It just provides just tendencies. But the market's been has had some pretty strong tendencies starting in the month of September over the last 75 years. And the market really has kind of gone opposite those tendencies this year, which has been kind of strange. Typically, we see a down September. This year, September was pretty strong. Normally, that third week or fourth week in October tends to be pretty weak. We went up. Since the October 27th close, the market historically does well. It kind of went up a little bit. Now it's coming back down. And this bullish period, by the way, extends through essentially this week, through Thursday's close. So, yeah, I mean, overall, normally we see some pretty good action. And we've seen a little bit of resiliency in the market, especially in the small caps, which have been pretty weak in the mornings of late, but then they come back later in the day and they're going to get tested again today because the futures on the QQQ down about 1.5% and the small cap almost 1.5% as well. So anyhow, some of that resiliency to be tested again this morning at the opening bell for sure. Palantir reported last night and the numbers were spectacular. I think everyone was looking for that. Palantir, the stock's been going up day after day after day, week after week, heading into its earnings. So it was hard for me to imagine anything but a blowout report. And we got that. But the reaction this morning has not been that great. At first, we had a little bit of movement to the upside in Palantir after they reported yesterday. But then we saw a sell-off. And this morning, the stock is now down over 8%, down $17 to $189.83. And it could simply be a case of many of these high octane growth stocks, the AI stocks, just maybe perfection priced in. This is the area of the market that's really been strong throughout this September-October period. It's been helping to lift the overall market. We've had many days where it's just been technology that's been outperforming the S&P 500. And some of that is kind of like a self-fulfilling prophecy. I mean, if you got technology going up more than the S&P and technology is 35% of the S&P, it's going to make it difficult for anything else in the S&P to outperform. But there's no doubt that this has been the area of strength. Technology continues to go up, whereas many of the other key sectors have been going sideways more. It's bullish sideways consolidation. But anyway, it looks today with the Palantir report that maybe we're going to see this trade kind of reverse back a little bit. Maybe some of those high octane growth stocks, the AI stocks in particular, maybe taking a little bit of a pause. And then the question is, does the market sell off or does that money just rotate into other areas of the market? That's, I think, going to be the key this week and maybe for the next few weeks, depending on how long any period of selling lasts in some of these AI stocks. Anyhow, let's take a look at a few things going on in the market. So let me get this set up for you. All right, so yesterday, Had the Dow Jones, it was a bifurcated day, by the way. You can see the Dow Jones down 226 points. That was down almost 0.5%, but the NASDAQ was up almost 0.5%, gaining 109 points. That's really what I was alluding to just a few minutes ago. It seems like the NASDAQ and those tech stocks have been leading consistently for the past few months, really throughout the secular bull market, but especially here of late. And that's what's really been helping the market sustain its move to the upside and continue to push to new all-time highs. S&P 500 was up another 11, almost 12 points yesterday. That was almost 0.2%, back above the 6850 level. And there you can see a little bit of mixed action in the mid caps and small caps. Small caps did rally to go positive at the end of the day. At least the S&P 600 went positive. I think the IWM did stay in the negative territory. The VIX, which had been up significantly throughout the early part of the session, did finish down for the day, but you can bet the VIX is going to be up again with futures down. My question is, do we get back up and get through that 20 level? If so, that opens the door, in my opinion, to perhaps a little bit more panicked type selling. Anything less than 20 on the VIX, and to me, I think we're still okay, but things can certainly pick up. That selling can escalate quite a bit with a VIX that's over 20. So that's something that I'll be watching for sure today and throughout this week. Looking at some of the leaders there on the S&P 500, actually, these are the laggards. Kimberly-Clark announced they were going to buy Kenvue. That usually when an acquirer announces an acquisition, you do see the acquirer go down unless it's really going to be accretive to earnings. In this case, Kimberly-Clark down 14%. Moderna, which seems to be on the S&P 500 laggard board quite often, down 8% yesterday, down another 2.25%. DoorDash has really started to weaken here. They report earnings this week. I'm not sure if I want to say within the next day or two, but double check me on that. But DoorDash, I believe, is reporting they're down $12. They were down $12 yesterday. Definitely weakening ahead of their report. Looking at some of the strength yesterday, IDXX actually reported. Stock gapped above some sideways consolidation. I thought it was a really strong day, real strong look to the chart. Kenvue, the one I was just talking about, you can see up more than 12% on that acquisition. All right, let's take a look at the S&P 500. So there's the S&P 500 breaking out, going sideways here the last few days. You know, the one thing that's interesting is the last 4 days we have closed below the open. Not by much, but we have closed a little bit below the open. Probably can see it a little clearer. I'm going to shorten this to 3 months instead of a year. But see all those filled candles? Anytime you've got a filled candle, this is a hollow candle. If you're not familiar with candlesticks, the difference between a filled candle and a hollow candle is a hollow candle is where you close above the open. So the bottom of this rectangle, forget about the little tails that come out the top and the bottom, but right here, this hollow candle, the bottom of the rectangle represents the open. The top of the rectangle represents the close. When you have a filled candle, whether it's red or black, the bottom is your close and the top is your open. So it has a little bit, when you look at it, that's why I love candlestick charts, because I can visualize very quickly whether or not the chart just looks a little bit more bearish. I would much rather see, in the case of the S&P 500, actually the last 5 days, I think I said 4 days, but it's 5 days in a row now where we've had a filled candle, meaning that we've closed below the open. So yeah, we might gap up, but we're not holding it into the closing bell. And today we weaken, and we're going to see a little bit of a sell-off, at least at the opening bell. Today the question is going to be, can we reverse it and print that hollow candle and show buying throughout the day? Can't answer that question yet. We'll have to wait for the end of the day. But this is 5 days in a row. Now, you might ask, okay, well, what's the difference between the black filled and the red filled? Good question. Red filled means not only did you close below the open, but you closed below the prior day's close. So here's the prior day's close. So you had a down day. Now, a black filled candle, on the other hand, is where you have a close below the open, but your close is still above yesterday's close. So that's the only difference, is that it finishes, you finish down from the open, but it was still an up day from the prior day. So imagine you're sitting at 6,800. You gap up to 6,850 and come down and close at 6,830. You still gain 30 points on the day, but you were down 20 from the open. That's going to be a black filled candle. Now, let's say you're 6,800 and you gap to 6,850, and then you come down and close at 6,750. That, in that case, you close below the open, 6,850 down to 6,750, but you also close down 50 points from the prior day. That's going to be a red filled candle. So black filled are a little bit more bullish in the sense that you did at least finish with an up day. It should be more bullish, with everything equal. You would think that with a black filled candle, your portfolio would do better because the S&P actually finished higher, but not necessarily. Depends on what stocks you own, obviously, or ETFs. Anyhow, that's the difference there. I use candlesticks all the time. I don't really talk about them that often, but that give you a little bit of a sense of the visualization, things you can use to kind of visualize the market if you use candlesticks. All right, Palantir. So I talked a little bit about Palantir a minute ago. Here is let me just give you the latest. 189.88 down $17. And if we pull the chart up and we look at the relative chart, you can see, it's been going straight up for the last week and a half, heading into its earnings report. So it was priced for perfection. And honestly, I think they just about delivered perfection. They beat top line, they beat bottom line, they raised their guidance, but the stock's down almost 10% anyway. And that's what makes holding any stock into earnings such a risky endeavor. I say it all the time. I can look at a chart and get a good sense of whether or not I think they're going to report good numbers or bad numbers or potentially bad numbers, but it's really difficult to gauge what's going to happen when the report comes out. What I would say is this: I think whenever you have a stock that has gone up as much as Palantir has, I think the risk is increased that even if they come out with a great report, you could still see a period of selling. Doesn't mean they're going to sell off. I'm just saying that there is a increased risk. I think holding a stock that is this far above its 20-day EMA into earnings, I think always carries a lot more risk. The stock could have gapped up $50. We've seen it before. But if it does gap down, you have literally, we're going to open down at this point based on where pre-market is anyway. We're going to open almost right on the 20-day moving average, which is at 187.49. That's not bad, technically. It's not a bad thing to go down and test your rising 20-day EMA. But if you held the stock or you bought it right before the close, that's not really helping much. You're down $20 or $18, whatever it was. So anyway, Palantir is going to be an interesting trade. Another stock's going to be reporting. I think they report tonight after the bell, Advanced Micro. Another one that's been making a big push to the upside for the last few weeks, starting back in the early part of October. But AMD, you can see it's just off the charts relative to its semiconductor peers. And of course, semiconductors have been really strong. What is AMD going to report? They're going to need to report something good in order to get a gap up because the stock has run so much. All right, let's take a look at the NASDAQ 100. So the NASDAQ, similar to the S&P, we're seeing filled candles, but we do continue to trade right up near that all-time high. Today, again, getting a gap down. I was looking, and you all won't be able to see this because I don't have my screen shared, but I'm going to go back and just take a look real quick at the NASDAQ's history here, because I want to tell you what the gap ups have looked like on. I'll give you the QQQ. Since October 1st, the QQQ has gapped down 5 times. And we're talking about now right around a month, a little over a month. So that would be about 22, 23 trading days. It's gapped down 5 times. That means it's gapped up like 17 or 18 times. The S&P 500 has gapped up. I can tell you heading into this week, it had gapped up 9 of the last 10 days. And it had only gapped down. The S&P 500 had only gapped down 3 times since October 1st. So this is a little different today, with futures down and with, looking like we're going to, unless something big happens before 9:30 within the next 15 minutes, certainly appears like we're going to have a gap down today across our major indices. And my point is that the S&P, and the only time, actually, none of the gap downs have been more than 1%. The last time the S&P 500 gapped down more than 1% was September 2nd. It's been a long time. We're talking more than 2 months since the last time the S&P gapped down more than 1%. The NASDAQ gapped down more than 1% on October 14th. And prior to that, September 2nd. And prior to that, August 1st. Prior to that, June 13th. When you're in a bear market, it's like every day. You're gapping down 1, 2, 3%. It's just, when you're in an uptrend, that's not the way the market works. The market, once Wall Street has accumulated the shares that it wants, the market tends to gap up. It tends to leave those who are non-believers, who are on the sidelines waiting for that next pullback. It tends to just leave them there wide-eyed, just staring at the market, because they can't believe that the market just keeps going up day after day after day. That's the way the market works. When we're in a downtrend, you want to be the heck out of the market. But once Wall Street has accumulated, that's when you want to be back in, because these gap ups occur repeatedly throughout the entire, in this case, the last 4 months. It's been almost every single day. All right, let me go back over, check out next chart. Let's take a look at the IWM. So we've seen more weakness on the IWM, but we've seen a little bit more afternoon strength. So I'm going to shorten this down to 3 months as well. And you can kind of see the filled candles. There have been 5 out of the last 6, but most of them are very narrow, meaning you can see these long tails. We've actually seen buying later in the day. And on Friday of last week, we actually did close above the open. And many of these other days, we've gotten back very close to the open. So the small caps have been gapping down more often, but they seem to be doing a little bit better during the trading day. And I'm not sure if that's a good sign for the longer term or not. I'm guessing we're going to have to wait and see. But I do like the fact that during the day, we are seeing some rotation away from the big technology names and into some of the small caps. Today is going to be a big test because they're all gapping down. What's going to happen from the open today? Does everything sell off, or do we start to see a reversal? Some of the things I would look for: technology, number one. So technology, you can see moving up, kind of like I was talking about. We saw Palantir and what Palantir's been doing over the last week and a half or so. Technology's been doing the same thing. Mostly these big gap ups. Not a lot of buying after the gap ups, but just big gap ups. And then we've been gapping up the last few days, but there's been some selling intraday, and now we're getting a gap down. And the XLK, I'll be watching to see if we can hold on to probably right around the 291, 292 area. Maybe even go down to about 289 and a half, because you got gap support. Actually, let me go ahead and annotate this. So you got this gap support right here, which began the gaps to the upside. And then you've got this prior price high, which now becomes support. That was prior resistance. We gapped above it, but that becomes support on the way back down. Then you've got the top of gap support right here from that first gap at 292.50, along with the 20-day moving average, which is 292.33. So we've got quite a bit of support in a fairly tight range on the XLK, between about 289.5 and 292.5. If we gap down, and I imagine the XLK, we're going to see more than that 1.5%. We'll probably see 2.5%. I'm guessing. I can check that for you. Let's see where we are in pre-market. 1.75, maybe closer to 2%, but right now 296. So still above that key area of support that I was just pointing out. But let's take a look at the other sectors, because while we haven't seen breakouts, I mean, we've seen Tesla picking up, we've seen Amazon breaking out, and that is certainly helping discretionary. Can't tell if we actually made the breakout. Let me shorten this again. Candle body, high candle body, October 2nd on the XLY was 242.32. Yesterday opened at 242.41, but couldn't sustain the move. Came back down and closed just beneath. So I would say we're testing resistance on the XLY, but we have not broken out. And this is kind of what's been happening in the market. So technology's been leading the major indices to new highs, new all-time highs, breaking out. The other areas, here's discretionary. This is not, I'm going to back up a little bit. Let's look at 6 months. I mean, this is sideways consolidation after an uptrend. This is bullish. This is a bullish look. We've got equal highs, rising lows. We could say that's ascending triangle. Or if we do go down and break that recent low around 233, I would just argue sideways, like a flag after an uptrend. That normally breaks to the upside. So I think the XLY, even though we haven't made that breakout, the XLY remains bullish in my view. Then we've got the XLC. XLC has not broken down yet. We haven't risen back up to test the high, but in my mind, we're still sideways consolidating. Now, if the XLC breaks down and closes, I mean, the recent low, 113-ish, would be one thing to watch. But I think similar to the XLK, what I would be watching, here's a gap. Then you got that prior price resistance. And then you got the top of the gap right here at about 112. So I'm looking at maybe somewhere between about 110.5 and 112 on the XLC. I'd like to see that hold. If that holds, and that's not too far off, that's only maybe 3% or so. But if money is rotating away from technology, what we want to see are some of these other bullish areas, the money rotating into those areas. We don't want them going down the same amount as technology. Technology's been leading, outperforming. It would be okay if technology were to pull back and underperform for a period of time. Let that money rotate in some of these other aggressive areas. Now, two areas that love the month of November, XLF, and really just love the fourth quarter in general. XLF looked like it was breaking down yesterday, came back, rallied, held. Does the money rotate some into the XLF today? That'll be really interesting. Along with the XLI, I'd say the same thing. Again, false breakout here. We tried to make a breakout just like we did with the XLY. Haven't been able to do it yet, but this is still bullish action after a rise. Going sideways and consolidating for a period of time is very bullish. So a breakout out of a consolidation period, which is what you would expect when that consolidation follows an uptrend, that would be very bullish. And that would help to absorb any weakness that we see short term in technology. So that's kind of the landscape right now with the different sectors. Because I have had some folks write in and say, Tom, some of the aggressive sectors aren't outperforming the S&P 500. Is that a problem? Not when technology is crushing the S&P 500. Because again, it just comes down to simple math. If you've got 35% of the S&P 500 that is crushing the S&P 500, the other 65% by default is probably going to underperform. So you've got to be careful. I mean, you can't, when somebody uses technical analysis and they say, well, this line is crossing this line, so therefore I'm going to put $20,000 into this stock. Well, I hope that you know what that line means when it's crossing before you decide you're just going to go ahead and put 20 grand into a trade. I mean, technical analysis is nice, but you need to understand what these lines mean And they certainly never provide you a guarantee on a trade. So, and I get that a lot. Well, Tom, you said when this line goes up, that's bullish. Well, it's going down. That means it's bearish. Not necessarily. Again, you have to use some common sense when you're looking at analyzing the market. It's not set in stone. I mean, it's not that easy just to say, oh, well, this line's going down and the market set a new high. Therefore, the market's topped and we're going to have a bear market. Really doesn't work like that. And you better get your facts together, because bear markets, I mean, we've gone through this period where we've had a lot of bear markets in a fairly short period of time. This is not normal. Normally, in a 20-year secular bull market, you might have 3, 4, possibly 5 bear markets, cyclical bear markets during the 20-year period. We've had 4 in 7 years. I mean, this has been crazy. And I think a lot of it's been Fed induced. Again, just my opinion. I think the Fed's been late to everything. I don't think this Fed has been ahead of the curve at all. I think this Fed is constantly trying to pick up the pieces of the last tornado they caused. And again, it has nothing to do with political. I've said this before, has nothing to do with what he's doing now with Trump in office. I said the same thing when Biden was in office. I think this Fed has been horrible. I think that they literally, I'm not thinking, they have been late to every party. Every time something happens, they started using monetary policy and their tools too late, after things had already kind of moved and gotten a little bit out of hand. Fortunately, we've been in a secular bull market, so we've been able to pick up the pieces. We've been resilient. We battled back, but there are some saying, well, that we battled back because of the Fed. I don't think that at all. I think that we've been resilient despite the Fed. I think the Fed is the one that's caused all the problems. But again, that's my opinion. You can disagree with it. That's fine. That's what an argument's all, that's what it's based on and what it's all about. If I have an argument about something, I mean, unless it's factual, you can feel free to disagree. And you're just as right as I am. No way to prove it, right? But again, just my opinion. So anyway, looking at the charts right now, I think when we look at these sectors, the thing that I find comforting is that none of the aggressive groups have broken down. None. And if we look, let's see what the pre-market is showing on these other groups. So XLK was went out 1.84. So it looks like gotten a little bit worse. XLY, down 1.27, but that's up near a breakout. So that's got plenty of room to the downside. No problem there. XLC is only down 0.7%, and it doesn't have as much room to fall. So that's a good thing. XLF is one I'll definitely be watching. That's only down 0.4%. So again, if we can see some rally, if we can see some of these sectors outside of technology, industrial is also down less than 0.5%. If we can see some of these other groups outside of technology kind of take the baton for a while, think of this as kind of like a 5x5 400-meter relay. Instead of 4x4, it's 5x5. You got 5 sectors, and they're constantly passing the baton back and forth to one another. When they all start to roll over, and they're showing relative weakness on the way up, and they start to roll over on their absolute chart, that's a problem. That's not what we have right now. So I just want to be clear. Now, does that mean we can't pull back further? Of course not. I mean, we could pull back further. Technology's been absolutely flying and carrying the market to the upside. If technology just takes a break for a couple weeks or 3 weeks, 4 weeks, whatever, that would certainly that would definitely hold the market back, because instead of 35% of the market showing relative strength, we'd have 35% of the market showing relative weakness. And that's obviously going to that's going to be a lot of headwinds. So that's just the way the market works. I mean, we're going to get rotation from time to time. But the fact that we've seen such strength in such a large, aggressive part of the market, I can't get bearish. I just can't. Not with technology flying. I heard one of the Fed officials yesterday said, he's not sure if he's going to vote for a rate cut in December because he's worried about inflation. Well, I can tell you Wall Street's not worried about inflation. Not with technology soaring the way it's been soaring. That wouldn't be happening, I can promise you. That's not what technology does with inflation on the horizon. Again, we need to follow what the charts are telling us, not what the talking heads are telling us. They don't know what's going on with the market. And the people who do know what's going on with the market aren't going to tell us until after the fact. That's just the way stock market works. You either deal with that or you sit back and say it's rigged. I mean, which it is to some extent. It really is. You got a lot of big money on Wall Street that controls everything, but you got to follow what they're doing with their money, not what they're saying on CNBC, or you've got their market making units, which are doing the opposite of whatever they're asking, or the analysts are telling us we should be doing. They come on, oh, this is a buy, this is a buy, this is a buy. Well, guess what? If we all buy, they're selling back at their home office. They got the market making unit that's on the opposite side of the trade. Conflict of interest, of course. It's a huge conflict of interest. One of the biggest conflict of interests I've ever seen in my life. But that's our system. So you either learn it or you suffer from it. Let's see, what else do we got? Actually, let's go ahead. It's 9:30. If you're new to earningsbeats.com, if you like us, the way we look at the market, which I think our guidance has been second to none. Nobody is, in my opinion, nobody's called the market the way we have over the last 7 years throughout all these bear markets. I think we've been on top of just about every one of them. Obviously, the pandemic was a very difficult thing to call. But what we did say was that it was a healthcare crisis, not a financial crisis, and that we would rebound all-time highs, which we did later that year. But anyhow, if you want to follow us, learn more about us at Earnings Beats, go over to our website, earningsbeats.com. Start your no-cost 30-day trial with that green button there. You can scroll down. We have a free, no credit card required newsletter, name, email address. That comes out Monday and Wednesday morning. I'll have another one out tomorrow morning for you. It's just a way to learn more about the market, learn more about the way we approach the market. We focus on technical analysis, but we also, just in our name, Earnings Beats, we follow fundamentals. We follow earnings and interest rates. That's what drives market and prices over time. So anyway, name, email address, hit that subscribe button. Make sure you like our video and subscribe to our channel. If you subscribe to our channel and then turn your notifications on when we do our live stream events, which are free, you can join us. So make sure that you subscribe to the channel. All right, last thing, let's take a look at what Palantir is doing live here. Palantir right now, up off its low. It was down to 180s. We saw them pre-market right now, 192. I mean, my gut is just with Palantir, I just can't imagine this stock stays down for long. I think we'll get some panic selling from folks that have bought the last couple of days. So maybe we see a little bit of early weakness. Maybe it lasts for a couple of days. Let's see what the weekly chart looks like. Because the 20-week moving average is probably the one that to me is the most important from a longer term perspective. And that's all the way down at 166. Now, if we go down to 166, we will probably be hitting some pretty key support levels on the NASDAQ and S&P. We're probably not going to be sitting where we are right now if Palantir gets down to 166. Looking at the intraday, let's just take a look at the major indices. So we got the diamonds, which gap down, continuing to move lower. The QQQ, same thing. QQQ down 1.6%. Spider down 1.2%. Little gap down, a little bit of selling there. And small caps also setting a new recent low, down 1.66%. And this one, I'm watching on the IWM, that recent low on that. Remember that big Friday sell-off where we got down to about 238? That's the level I'm watching there. We're down to 50-day moving average, which over the course of the last several months, that's been a pretty good area to buy the IWM. I think from here down to 238 is pretty key support on IWM. If it fails to hold, I certainly would not be in my leverage position, and I would even consider moving to cash, especially if that VIX is going up above 20. I know this is a bullish time of the year, but I don't mess with a market. That's like sticking your hand in a hornet's nest. When you get the VIX over 20, You really don't want to get multiple stings, and that's what can happen. Just be careful out there. If the selling escalates to that point, let's see where the VIX is right now. VIX at 1929. Went up, looks like it went up above 20 earlier. I don't know if that was true or not, but if we close over 20, that's when sometimes that selling can really escalate. So just be careful out there today, and we'll see how it goes. We'll be back tomorrow for our live trading room. So if you do start your 30-day trial, you can join me in our trading room tomorrow. Anyway, have a great rest of your day, everybody. Happy trading.